What if the next recession is not a surprise but a signal? And the real question is not whether it is coming, but whether you will be ready when it arrives. Right now, while headlines remain calm and daily life feels predictable, subtle forces are moving beneath the surface of the economy. Leading indicators are shifting. The yield curve has inverted again. These are not dramatic breaking news alerts designed to scare the public. They are quiet warnings, the kind that only disciplined observers take seriously. History has shown us that markets whisper before they scream, and those who learn to listen to the whispers position themselves long before the crowd begins to panic. The year 2026 may still seem distant, but preparation does not begin when fear spreads. Preparation begins when signals first appear. This is not about predicting doom. It is about cultivating awareness, discipline, and strength in uncertain times. Economic cycles are natural. Expansion and contraction are part of a larger rhythm. The mistake most people make is believing that prosperity is permanent and downturns are temporary anomalies. In reality, both phases are temporary. The only constant is change, and those who respect that truth gain an advantage that goes far beyond money. When leading indicators start flashing warning signs, experienced institutional investors do not react emotionally. They analyze, they reassess risk exposure, they examine liquidity, they ask difficult questions about sustainability, debt levels, and asset valuations. An inverted yield curve, which has historically preceded recessions, is not magic, but it is meaningful. It reflects expectations about future growth and interest rates. It represents collective intelligence embedded within financial markets. Ignoring such signals because the present still feels comfortable is like ignoring dark clouds because the rain has not started yet. Strategic minds understand that by the time the storm is visible to everyone, it is often too late to prepare calmly. Defensive positioning does not mean fear. It means resilience. It means strengthening balance sheets, diversifying wisely, preserving cash when necessary, and resisting the temptation to chase speculative gains. This mindset echoes the disciplined philosophy associated with leaders like Abigail Johnson, whose approach emphasizes long-term thinking, risk management, and steady conviction even when markets fluctuate. The lesson is not to predict exact dates or dramatic collapses. The lesson is to build a structure strong enough to withstand volatility whenever it comes. Many individuals fall into the trap of reacting instead of preparing. They wait for confirmation from the crowd. They wait for headlines to validate what the data has already suggested. But by then, asset prices have already adjusted, opportunities have narrowed, and fear dominates decision-making. True confidence is built before the crisis, not during it. Think about the psychology of panic. When markets drop sharply, people do not suddenly become irrational. They reveal the lack of preparation that was always there. They sell because they feel trapped. They feel trapped because they position themselves without considering risk. Preparation transforms fear into clarity. When you have built reserves, reduced unnecessary liabilities, and aligned your investments with long-term strategy, volatility becomes manageable instead of paralyzing. The concept of positioning defensively now instead of reacting too late is not a call to retreat from ambition. It is a call to refine it. It is about building financial strength that allows you to act decisively when others hesitate. As 2026 approaches, uncertainty will continue to circulate in conversations about inflation, interest rates, geopolitical tension, and corporate earnings. Some analysts will dismiss the warning signs. Others will amplify them dramatically. Noise will increase. Opinions will clash. Yet beneath the noise, the data will continue to tell a story. The question is whether you will choose discipline over distraction. Every economic downturn in history has also created opportunities for those who prepared in advance. Assets become undervalued. Strong businesses expand while weaker competitors retreat. Innovation accelerates under pressure. But only those with patience and capital are able to participate. The crowd often sees recession as an ending. Strategic thinkers see it as a transition. Preparation is not glamorous. It requires restraint when others are celebrating. trading. It requires humility when markets are rising. It requires patience when quick profits seem tempting. But this quiet discipline is what separates reaction from intention. Imagine looking back in 2026 and asking yourself whether you acted when the signals first appeared or whether you waited until fear forced your hand. That reflection begins today. Strength is not built in comfortable moments. It is built in anticipation of challenge. The inverted yield curve is not destiny, but it is information. Leading indicators are not guarantees, but they are guidance. You do not control global markets, but you control your preparation, your mindset, and your response. Economic cycles will continue long after any single year passes. The real investment is not just financial capital, it is mental capital. The ability to remain calm, analytical, and forward-thinking when uncertainty grows is a skill that compounds over time. If a recession does arrive in 2026, those who prepared will not be shocked. They will be ready. And readiness, more than prediction, is the foundation of lasting success. There is a moment in every economic cycle when confidence quietly turns into complacency, and complacency becomes the seed of vulnerability. That moment rarely announces itself. It arrives gradually, disguised as stability, disguised as normal growth, disguised as reassurance from experts who believe the system is stronger than ever. Yet beneath that calm surface, pressure builds. Corporate debt levels rise. Consumer spending stretches beyond sustainable limits. Asset prices climb higher than their underlying value justifies. And while the public celebrates new highs, institutional investors begin adjusting quietly, not because they are afraid, but because they understand that cycles reward discipline and punish denial. This is where suspense begins, not in a dramatic market crash, but in the subtle shift from optimism to overconfidence. The warning signs we see today, including leading indicators slowing and the inverted yield curve persisting, are not random. They are reflections of expectations embedded in the financial system. They are signals that growth may not continue at the same pace and that risk may be mispriced. The question is not whether you can stop a recession. The question is whether you can recognize the difference between temporary noise and structural change. Preparation requires emotional maturity. It requires the willingness to stand apart from the crowd when the crowd feels certain. When markets are rising, reducing risk feels uncomfortable. Holding cash feels unproductive. Rebalancing portfolios feels overly cautious. Yet history consistently demonstrates that the most painful losses occur when investors ignore risk because recent returns have been strong. True leadership in finance, the kind associated with strategic thinkers like Abigail Johnson, emphasizes patience over impulse and resilience over excitement. This mindset does not chase momentum blindly. It evaluates valuation, liquidity, and long-term sustainability. It understands that protecting capital during uncertain periods is just as important as growing it during expansions. Many people assume that wealth is built only through aggressive action, but sustainable wealth is built through intelligent restraint. The ability to say no to excessive risk when everyone else says yes is a quiet form of strength that becomes visible only when volatility returns. As uncertainty grows, narratives will compete for your attention. Some will argue that this time is different, that structural innovation, technological progress, and strong labor markets will prevent any significant downturn. Others will insist that collapse is inevitable and imminent. Between these extremes lies the disciplined path of analysis. Suspense intensifies because data rarely provides absolute clarity. Indicators may soften gradually, earnings may decline slightly before stabilizing. Employment numbers may fluctuate unpredictably. There may be months of recovery that create false confidence before another downturn follows. This ambiguity tests conviction. It tests whether your strategy is built on principles or on emotion. If your positioning depends on constant reassurance, you will find yourself adjusting repeatedly, reacting to every headline. But if your strategy is grounded in long-term discipline, short-term volatility becomes less threatening. You begin to see uncertainty not as chaos, but as a natural environment in which thoughtful preparation thrives. Consider the institutional perspective. Large investment firms do not wait for official recession declarations to adjust their allocations. They analyze forward-looking data, they assess credit spreads, they evaluate liquidity conditions, they stress test portfolios under adverse scenarios. They prepare for outcomes that may never occur because the cost of preparation is often far lower than the cost of reaction. This approach is not pessimistic. It is pragmatic. It acknowledges that the future cannot be predicted with precision, but it can be approached with resilience. If a 2026 recession is indeed forming beneath the surface, its early stages will not be dramatic. They will appear as minor contractions, slower growth, tightening credit, cautious corporate guidance. Only later, when layoffs increase and markets decline sharply, will the broader public recognize what data had already suggested. By then, opportunities to reposition calmly may have narrowed. Suspense reaches its peak in that transition period when some still deny the shift while others begin to sense that momentum has changed. The deeper lesson extends beyond financial markets. It speaks to personal responsibility and foresight. Economic cycles mirror life cycles. Prosperity can create illusion. Stability can encourage risk-taking beyond reason. But resilience is built not by assuming endless growth, but by preparing for inevitable fluctuation. Defensive positioning is not about retreating from ambition. It is about strengthening foundations so ambition can survive disruption. It may involve reducing leverage, diversifying income streams, enhancing skills, building emergency reserves, or reevaluating investment concentration. These actions may seem conservative during expansion, but they become empowering during contraction. When others are forced to make decisions under pressure, you retain choice. And choice is power. There is suspense in waiting, in watching indicators evolve, in observing whether warning signs intensify or fade. Yet waiting does not mean inactivity. It means disciplined observation paired with strategic adjustment. It means asking difficult questions about vulnerability before circumstances demand answers. If the economic environment weakens further, will your finances withstand reduced income or declining asset values? If credit tightens, will you still have flexibility? If markets drop sharply, will you have liquidity to seize undervalued opportunities? These questions may feel uncomfortable now, but discomfort during preparation prevents desperation during crisis. The difference between reacting too late and positioning early is measured not only in financial returns, but in emotional stability. As 2026 approaches, uncertainty will continue to build gradually, and the suspense will test conviction. The choice remains simple yet profound. Ignore the signals and hope for the best, or acknowledge them and build strength in advance. The path of discipline may not attract applause today, but when volatility arrives, it becomes the quiet advantage that defines long-term success. When you step back and view economic cycles as part of a larger rhythm rather than as isolated events, you begin to understand that preparation is not an occasional effort. It is a mindset, a way of approaching uncertainty with clarity and intention. The warnings we observe now, the inverted yield curves, the slowing leading indicators, and the subtle shifts in consumer and corporate behavior are all pieces of a larger puzzle that reveals patterns if we choose to see them. Yet seeing patterns is not enough. Action is required. Action grounded in intelligence, patience, and strategy. It is easy to become overwhelmed by predictions of doom or intoxicated by the exuberance of growth. But those who thrive through cycles are neither blind optimists nor constant pessimists. They are disciplined observers, understanding that success lies in the balance between caution and opportunity. Abigail Johnson exemplifies this philosophy, demonstrating that careful planning, respect for risk, and long-term thinking produce outcomes far superior to reactive decision-making driven by emotion or fear. Her approach reminds us that preparation is a quiet, consistent practice, often invisible to the public eye, yet profoundly impactful when circumstances change. The concept of positioning defensively now, rather than reacting too late, is not merely financial advice. It is a principle of resilience applicable to all areas of life where uncertainty exists. Suspense builds because uncertainty is never fully resolved. We may never know with complete precision when the next downturn will arrive, how deep it will be, or which sectors will suffer most. This ambiguity creates tension, and tension creates opportunity for those willing to act with foresight rather than instinct. The early stages of any economic contraction are often subtle. A slight slowdown in earnings growth, cautious statements from major corporations, minor tightening in credit conditions, but these subtle changes precede visible panic. It is in this liminal space between apparent calm and emerging crisis that preparation matters most. Those who understand this cultivate patience and awareness, recognizing that decisive action is most effective when guided by observation rather than reaction. They do not wait for chaos to dictate choices. They anticipate, they plan, they allocate resources strategically. In doing so, they transform suspense and uncertainty from sources of anxiety into instruments of empowerment. This mindset is cultivated through discipline, reflection, and the consistent application of principles that prioritize long-term stability over short-term gratification. Understanding financial cycles also teaches the value of mental and emotional resilience. Markets are influenced by human psychology as much as by data, and the collective emotion of investors can amplify both growth and decline. When optimism turns to overconfidence, when caution is ignored in favor of speculative enthusiasm, vulnerability accumulates. Conversely, when a disciplined mindset prevails, opportunities emerge even during contraction. Strategic investors, inspired by the philosophy of leaders like Abigail Johnson, recognize that downturns can reveal hidden value, new possibilities, and pathways for growth that are not visible during periods of complacent prosperity. They understand that wealth is not simply a measure of money accumulated during good times, but a reflection of decisions made consistently, calmly, and intelligently, regardless of external circumstances. This approach reframes the idea of a recession from a threat into a challenge, an inevitable phase in a larger cycle that rewards foresight, patience, and strategic positioning. As the economic landscape shifts toward 2026, the signals are becoming increasingly significant. Leading indicators provide early warnings, and the inverted yield curve signals growing concern among those who understand market dynamics. For many, these signals are confusing or unsettling, especially when daily life still appears stable. The challenge lies in acknowledging risk without succumbing to panic, in preparing strategically without assuming certainty, and in maintaining flexibility while committing to long-term principles. Preparation is not merely defensive, it is proactive. It allows you to capitalize on opportunities when they arise, rather than scrambling to respond under pressure. Just as Abigail Johnson emphasizes careful planning and resilience in investment, the same mindset applies to individuals navigating uncertain times. By cultivating awareness, discipline, and strategic foresight now, you ensure that when challenges arrive, you retain the capacity to act with confidence, clarity, and advantage. There is a critical lesson in observing how institutional investors operate during periods of subtle economic warning. Unlike the general public, they do not wait for crises to be declared by headline news or public sentiment. They analyze, model, and stress test potential outcomes in advance. They prepare for scenarios that may never occur because the cost of preparation is far lower than the cost of reactive decisions made under duress. This principle extends beyond finance. Whether applied to personal goals, career planning, or life's inevitable uncertainties, preparation transforms suspense into opportunity. By observing indicators, assessing risk, and acting in alignment with long-term strategy, you build resilience and create space for decisive action when volatility strikes. Suspense in this context is not fear. It is the edge of awareness, the threshold where discipline allows advantage to manifest. Those who master this threshold gain not only protection from loss, but also the ability to identify and seize opportunity. The lesson of 2026 extends to the human mind as much as to financial systems. Patience, self-awareness, and foresight are cultivated qualities that compound over time, just as careful investment decisions do. Emotional discipline becomes a form of leverage, allowing calm, intentional action when the broader environment is reactive and uncertain. Economic cycles are not interruptions to life. They are reminders that growth, decline, opportunity, and risk coexist in every period. By accepting this reality and preparing thoughtfully, you develop the capacity to navigate challenges without losing direction, confidence, or vision. Leaders like Abigail Johnson illustrate that success is less about predicting exact outcomes and more about cultivating a mindset that anticipates, adapts, and responds intelligently to change. In a world where uncertainty is the only certainty, this mindset is your most reliable asset. Ultimately, the message is clear. Positioning defensively now, observing leading indicators, and respecting the lessons embedded in market signals are not merely financial strategies. They are philosophies for life. By understanding cycles, preparing with discipline, and maintaining resilience, you equip yourself to face not only the potential recession of 2026, but every challenge that follows with clarity and confidence. The suspense of uncertainty, the tension between calm and crisis, is not a threat if you approach it with intention. It is a proving ground for foresight, patience, and strategic thinking. By internalizing these principles, inspired by the disciplined approaches of leaders like Abigail Johnson, you gain control over outcomes that would otherwise be dictated by circumstances, panic, or inaction. You cultivate strength that persists, clarity that guides, and opportunity that emerges from preparation. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.